Well, it says we're live here. I will give it one more minute to allow some folks to come on who want to take the opportunity on a Sunday evening to enter the Independent Investor Channel open forum that we run here on the live stream. We won't be doing a typical 2-hour live stream on a Sunday evening. However, I thought it prudent to come on and open up the community dialogue. We did end up missing Friday, obviously, and I do apologize for that. But happy Mother's Day to everybody that's joining in. Certainly hope you guys had a wonderful day. Hope you had a relaxing day celebrating all the mothers out there. Fantastic to have everybody with me. Looking to share in the goal of empowering one investor at a time, that of which I believe we are doing. I know there's going to be a ton of people who perhaps maybe are never introduced to the opportunity to understand the option of self-directed investing. And that's certainly our goal, is to push out that awareness. And I think, you know, we're doing that slowly. It's an infinite topic insofar as if I took 100 investors and gave them X amount of dollars, it really isn't about the dollars. But if you took 100 investors and you asked them to invest in the stock market, the interesting part about that experiment would be what type of results would those 100 investors produce. And I tend to think that if we put that type of charge on 100 different investors, I think a lot of folks would kind of go with the mainstream. I think a lot of people would go with the normal course of the understood norm in society with regard to how we seek our entrance into the stock market. And it's interesting because I've been one of those investors. I've been with 4 brokerage houses in the history of my investing career over the last 25 is what I typically say. That's about right. I started investing around 16 years old. So I've gained a lot of financial experience, wisdom probably over the course of that experience as well. I'm not a professional, nor do I want to be, nor do I believe that you need to be successful in the stock market. And those are some of the gaps that we're looking to bridge for folks. And they are bridgeable, okay? But you introduce the prospects of putting somebody in charge of their own money when they mentally have themselves conditioned that they can't do it is a very, very, it's a very tough feat, okay? I have a very, very steep learning curve. And I acknowledge that for a lot of people. I really do. Investing in and of itself is very scary for a lot of people. I get it. A lot of people don't even want to talk about the topic. A lot of people think that they're very grounded and have it in complete control, when in my assessment, they're completely out of control. So to each his own in the perspective of financial awareness, financial stewardship, financial wealth building. And I do acknowledge that each individual program is going to be a little bit different. But the video that I released today hopefully helped everybody. If you haven't had a chance to catch the misconceptions video, it's been one that's been on my mind for a long time. I've had one of the questions kick into the group here asking if the work obligation is complete, and it is. We're going to hope to increase the upload schedule on the Independent Investor channel. That's just going to happen naturally. Okay. I do what I can when I can. Very, very simple. Okay. I don't do YouTube for a living. So for you guys that are joining in on the message for the first time, please understand my goal is a collective goal. And I provide these injects of opportunity for folks to come on and strike up a dialogue, because I can't do it all myself. Okay, I see Ernest has popped in the group here. I've got Average Joe Investing, who's popped on here on a Sunday evening to say hello. I do appreciate that. I just saw my good friend Brent has popped in here as well from the Financial Investor, as well as Investing Wisely, popping in to say hello. All the best to you guys. Certainly, I will look to probably go an hour depending on what type of traffic we have this evening. I do acknowledge that we do have Mother's Day going on. I had a bit of fun today with my family. It was a great time. but certainly wanted to make up the lapse in the live stream on Friday. I see Ryan Rom Tech actually drop a comment here looking for probably a drop in the market tomorrow. I think you're probably right on that. I think we're probably going to drop quite a bit significantly pre-market. I don't want to overblow the China trade talks, certainly, but this is one thing that you're going to need to understand, depending on your level of experience in the stock market, is there is no perfect stock market. All right, there is always going to be some level of political risk. In this particular case, some level of geopolitical risk. And I think sometimes, especially Americans, were somewhat shielded by some of that. We typically lose sight of the fact that there's some turmoil around the world. There really is. And as good as the U.S. stock market can be, I typically want to encourage everybody to understand that with the tariff talks and the trade negotiations looking like they're going to be significantly more prolonged, it could cause some ripple effect in the stock market. Now, whether or not it's completely, if it's completely related to trade, I'm not sure if I'm completely in that camp, because remember, we've had one of the best starts to the stock market this year. So if you had justified being on the sideline for the start of 2019, you've really missed out, okay? And some of the things that I'm going to kind of hit on tonight are some of those basic investing 101 principles, to where if you're tuning into the Independent Investor channel and you're listening and you're looking at me for some guidance, I'm going to give it to you free of charge, okay? I did touch on this in the video. We're building this community to be powerful in that information that is typically taken, misconstrued, bundled up in a small package, and then resold back to people is going to stop, okay? And it's going to stop with me. It really is. Now, if you feel like you need to go out there and pay for service, I touched on this in the video today, in that I feel like so many people need to pay for things. They feel obligated to pay, no matter what it is. You want to lose weight, you got to pay. You want to, eat better, you got to pay. You got to pay a coach. You got to get the mind right. You got to pay. And it's surprising to a lot of people on this channel, where I've had a lot of people ask me, what's the catch? What's the catch, Ryan? And I just think that we can be a whole heck of a lot more powerful if we're delivering an empowering message that people can take and deploy in their own financial lives. I've already done that, okay? The think and grow rich philosophy is very, very real, all right? There was a pretty alarming statistic that I heard come through the airwaves yesterday, and interesting enough, and I speak to a lot of people. I make around the average income in the US, nothing special, okay? I'm very open with my financial net worth, my portfolio, and my specific portfolio holdings, both on the fixed equity side, the single stock side of the house, and my ETF exposure for the diversified passive products that I hold in my portfolio. But the statistic was staggering, in that a $400 unexpected charge to a household that makes around the median income, okay, of $55,000 a year would be devastating to someone's financial health and well-being. Furthermore, not only would the $400 devastate that because of the lack of emergency fund savings built up, but it would also spoke to $1,500 out of those dollars every single year going to wasted costs that are in excess of what you actually need: food, fuel, housing, clothes, utilities, things of that nature, which I consider sunken cost. All right, now I've done a lot of videos on budgeting. I don't want to bore you on a Sunday night with budgeting, but there's a lot of people out there that are trying to make sense of investing when they haven't made sense of the budget side of the house and haven't really made sense of the checking and savings aspect that I discussed on the video that will be released later on this week. In how many accounts do you actually need? And I'll do a sequential breakdown of the different accounts from my perspective on how I strategically use a checking account, how I strategically use a savings account. And for you guys that have tuned into me for a while, You guys know how aggressive I am on making sure that your fitness to enter the stock market is adequate. All right. And I'm not your dad. Okay. Who am I to tell you that you're fit or not fit to enter the stock market? What I tend to try to premise is that your preparation to enter into the stock market will contribute to your success in the stock market if your fitness is strong before you enter into it, and you've got that real nice buffer of liquid cash that kind of provides you that buffer to the volatility in the stock market. So yes, I do acknowledge that the tariffs are going on. I've actually got some buy orders in for tomorrow morning in some growth companies. That's really not in relation to the tariff talk right now. What I mean by that is I'm not making my strategic buys tomorrow out of fear, or I'm not going to wait on my buys tomorrow out of optimism. I'm just buying those because those particular growth stocks are stocks that I've been looking at for a while. And I'm going to go ahead and add that little bit of exposure to the portfolio. And I'll just let you guys know I'm purchasing some Adobe systems tomorrow. I took a nice profit a couple weeks ago. I'm entering back into Adobe systems. I'm entering a small position in PayPal holdings. I'm entering a position into Salesforce.com. One of my favorite consumer discretionary, which I'm very deficient in. I'm about 4% in consumer discretionary right now. And I wanted to add some consumer discretionary to the portfolio. And Booking Holdings was the best name that I found, trading at about 20 times earnings. The PEGI ratio is about as close to 1 as I like to see it, 1.3. So very attractive for a quick growing company, the world's leader in online booking. They're in over 200 countries. So Booking Holdings will be one company that I'm taking part in. You'll see this video probably hit later on this week, but I'm giving you guys a premise for anybody that's tuning into the live stream tonight. And then finally, my absolute favorite stock out of any growth stock in the stock market, I definitely have my sector favorites. But Google, ticker symbol GOOGL, buying the Class A shares tomorrow morning, just a 5-share position. My largest buy order tomorrow is for Booking Holdings at 5 shares. So pretty good for a little fellow like me. Entering into some growth companies tomorrow, relatively small percentage of the portfolio. You guys know that I've got a lot of cash on the side right now. Still currently with everything going on, have just been a real winner this year, 2019. Took a lot of profit off the table. I see Avi A in the group. I haven't seen for a while. Profit taking has been a good idea given the rise of the trade war. I can tell you this. I sometimes am right and I'm sometimes wrong. And you guys need to get used to that as well. Don't tune into the Independent Investor channel, or don't listen to Ernest, who's in the group here, or Financial Investor, or quite frankly, anybody. I don't care if you consider yourself an expert or not. There's nobody out there that can forecast what the stock market's going to do. Nobody. I don't care. If you have somebody that'll sit in front of you and tell you that they're an expert on the market, or act a fool because they think they're a market, it will humble those people as well. And I would encourage you guys to get up out of your chair and walk the other way. You don't need it. I don't need it. I don't profess that at all. But I will say that leading up to the last couple weeks of increased volatility, we were striking up that dialogue of saying, hey, listen, let's look at where the stock market is currently. Let's look at our portfolios, and if there's any way of taking off some of the white meat, taking some risk off the table, that would have been the time to do it. And I know there's a lot of community members that did just that. I did it. I'm a happy man. I sleep well at night. I actually did a very interesting swing trade on Friday. Because when the market dipped super low, I think it was down 350, maybe 450 actually at the low, if I'm remembering. I actually quickly placed a trade. It took me about 26. Thank you very much, Daniel. I appreciate that on a Sunday night. But I quickly entered in. It took me about 12 seconds to go ahead and buy the S&P 500. I actually bought the S&P 500 and I bought a little bit more VTI. I actually bought both of them right then and there. Bought it long, and then actually came home and watched the market go up 150 points and actually sold those blocks of ETFs for a significant profit on the same day. So just real interesting stuff. I always am glad to give you the insight on those types of fun trades within the Roth IRA. Certainly still keeping a core holding in VTI. I did sell the position in VOO because I do hold the S&P 500 in a different index fund in my my employee sponsored retirement account. So everything that I talked about today on the misconceptions video, I hope you guys appreciated that. That was pretty cool. Been waiting to do that topic for quite some time, but I'm going to do a rundown here, see if I can't get to some of these questions in the group. Daniel, thank you for that. I appreciate the support. And again, happy Mother's Day to all you guys that are joining the live stream this evening. Really, really appreciate your support. Just a few small announcements on the channel. Again, my work obligation has complete, at least the one that consumed a significant amount of my time. You'll notice a small grin on the side of my face. I'm very happy with that. So it's kind of good to be back here doing my YouTube project, and that's really what this is. I will move as slow or as fast as you guys want to move in building up this community of awareness. And at the end of the day, that's what I want to do. If we're going to move too fast on building this channel, and we're going to do it at the compromise of the integrity of the message, then we're going to slow it right the hell down. And I don't mind doing that. Okay. I'm very, very aggressive on making sure that each and every person has an equal and open opportunity to come seek out answers to the questions that they may have with regard to this conceived scary topic. Okay. It's a lot of fun for me. And hopefully you guys look at me as an advocate for the topic. I am. Okay. I'm living, breathing proof that you can do this. And I'm much more fit now than I was a couple of years ago when I started the Independent Investor channel. I knew it made sense then, but when you've got multiple years under your belt as a self-directed investor, and you can sit across from an audience and kind of say, hey, listen, these are your areas of focus. If you can do nothing else, start introducing yourself to some of these concepts and, dare to make this topic something that's a little bit more of a hobby for you, okay? It's not going to be one of those things that you can just put away, put asleep, and turn off, and it's going to work for you. It's going to be a machine that's going to require some maintenance. It's going to work for you, okay? We can talk about assets within your retirement account that can be forgotten about for 30, 40 years. We can do that, all right? We wouldn't be having this discussion if we couldn't provide products that were good for all investors, whether it be 18 years old looking to get invested and say, hey, Ryan, I'm not really interested in the single stock risk. I'm interested more in the diversified, passive, exchange traded fund option that you talk about. I've looked at Vanguard. Those are the types of questions that I really like, in that somebody's kind of taken a little bit of initiative and done a little bit of research on their own and said, hey, I like what I see here, man. Can you explain this, cheapest ETF when compared to 90% of the rest of the industry? Can you explain that a little bit? That I really like, because it shows that empowerment that we're looking for, and people aren't just looking to come onto the community and be reactive on information that they know that I research, which I do, but we're doing about half the battle unless we're teaching people to really go on there and seek out those validations for themselves, guys. So about 20 minutes into the live stream here, want to welcome everybody who's made their way in. I'm going to take a cruise down here. Welcome Christopher Blaine here, who's in the group. Ryan, I can only stay online until my wife tells me it's time for Game of Thrones. And I responded back and said, you got to have priorities, man. That's true. Game of Thrones is way more exciting than me, for sure. But I don't think people tune into the Independent Investor channel for entertainment. That's for sure. I have my moments, maybe, but I'm not really that entertaining of a fella, but that's all right. K97's in the group here. Awesome surprise. Still hoping you and Joe Carlson do a collab. Are you done with your work commitment? I am. I saw your ETF M1 Pi. I did share that in the Facebook group. Very simple S&P 500, S&P 500 sector specific ETF portfolio that I built through M1 Finance. Very simple. Okay. It's performing quite well. The diversification is working. Okay, that's what it's there for. It's not going anywhere. It will slowly grow over time as I fund that. And we'll talk a little bit about those things that you can kind of bring yourself up to speed if you're a new investor, and some of these terms that we throw out are a little bit new to you, like dollar cost averaging, dividend reinvestment, things of that nature, portfolio reinvestment. That's what M1 Finance has. So a little bit different things that you don't need to be scared off the topic. Okay, you're not stupid. All right, you're just new to it, just like everybody was at some point. But don't turn off the message. Embrace it. All right, embrace those terms. And if you don't know something that somebody's talking about in both the community or something that I say, please just stop me and say, hey, can you explain what you're talking about? So I would do a collab with Joe. I think he's doing quite a good job on his own on the channel. I think he's doing really well. He's growing faster than any channel that I've seen come out, and rightfully so. The information is quite good. He's been accused of having a radio voice, which I agree with. It's pretty interesting to listen to. But I just wish him all the best, because I think that at the end of the day, there's people benefiting from the information. And I don't sense for a second that he's doing it for, personal gain. Now, that doesn't mean that you're not doing YouTube for personal gain, but I think his motives are good. I sense that there's a lot of wealth there of knowledge to be shared with beginning investors. I would be glad to do it. I think it'd be fun. I've only done a collaboration with one individual on YouTube, only one, and that's Ryan Scribner. That's it. There's only a handful of folks that I would even consider doing a collaboration with, outside of about a half a dozen, maybe a half a dozen. But outside of that, I would tell them, no, I'm not interested, because I'm not really. I like my network of people. I've built up my community. They relate with me and I relate with them. It's that simple. And the strength of that building the channel is really, it's special in my opinion. And that's how you do it correctly. But I'm glad to have you kick into the group here. I'm working on a project in M1 Finance that you guys might want to listen up to. It's been kind of interesting. I've scoured over the Vanguard ETFs that have less than 100 holdings. And if you guys have never thought about just carrying those holdings over to M1 Finance and delivering and eliminating the 10 basis point of expense within the sector specific ETFs, there's about 4 or 5 ETFs that I've identified. I've got the list here, actually. It was a little homework assignment that I had for myself. EPU with the utilities has 68 holdings. You could just as easily take and put 1% into each of those and you just hit equalize. Basically, you drop all 68 holdings into an M1 Pi and hit equalize, and it's going to adjust the percentages. And then you can go through each holding and say, well, based on market cap, you want Nextera, you want Duke and Dominion and Southern Energy to have the higher weightings, and then you can adjust the other ones down. The problem a little bit is that you can't go below 1%. So everything has a 1% base in it. But interesting enough, you can get exposure to some of these Vanguard sector specific ETFs with 0 expense ratio. So I'm giving you guys kind of an interesting secret. And I know Ernest probably sits back and listens to these brilliant ideas, and he's going to go in there and look at it and see what I'm talking about. Unfortunately, M1 Finance does cap the amount of stocks that you can throw into one pie at 100. So some of these larger, like discretionary, has 294 names in it. You obviously can't do it with that unless you wanted to cherry pick the ETF, but then you wouldn't be owning the entire sector. But some of these other ones, like Vanguard's materials sector spider ETF, which I've actually taken a position in this week, a small position. Now I own them all, split between the 2 Roth IRAs. This is in addition to the M1 Finance account, okay? So materials has 118. The telecommunications sector spider ETF has 107, right? So you could do it there. Staples has 92. Energy has 136, and then real estate has 188. So a little bit more than you could potentially do, but just an interesting idea about how you could utilize the M1 platform to get yourself a no-fee representation of these specific sectors. So interesting kind of project that I've been working on, but I could absolutely build a dividend pie within M1 Finance. And this is part of the research that I put up on the board here with building watch lists. I think I could expand on that advice for you guys in that whatever brokerage you choose, whether it be M1 Finance or Merrill Edge or Fidelity or TD Ameritrade or Schwab or any of the other brokers, it's going to be in your best interest to get familiar with the particulars of that platform. And building a watch list is going to be one of many functions in there. And I don't want to scare you off of it, all right? But you have to understand that a lot of that research and analytics is provided to you pretty much free of charge, okay? And so you don't want to let that lie dormant. You want to take advantage of that when time permits. And again, a little bit of research goes a long, long way in identifying what type of assets over here you'd be looking to at least build into a watch list. And that way you'll have some of that stuff. See, I could pull my watch list for dividends and just drop it right into an M1 pie and have that built for you, share it through the Facebook group. Easy as pie, no pun intended, okay? But I don't dividend reinvest. I don't dividend invest through M1 Finance. You guys know that. Now, I do have the sector spider ETFs through M1 Finance funding the portfolio. So I do have portfolio reinvestment going on within M1 Finance. But my large dividend holdings, you guys know, are with Merrill Edge. So easy enough to kind of build a pie, share it with the group. I could do that. Certainly, it's going to have names like, you know, your 3M, your Caterpillar, you know, some of your dividend aristocrats, a lot of your energy names, utilities, etc. Chevron has really just been on fire. ExxonMobil, some of the utilities that I've already named, Nextera, Southern, Duke Energy, Dominion, some of those great names. Forties is another one. Some of those utility names, discretionary staples, some very, very good staples, some defense, some industrials. So in the defense subsector, you've got Lockheed Martin, Honeywell, Raytheon, some of my favorite, Northrop Grumman, you know, Boeing, of course, is a holding of mine. That would be a dividend payer. And the list goes on and on, FedEx, some really good stuff in there. Healthy dividend, we're looking at from about 2% to 4%, okay? Sometimes you can stretch it with a Verizon or an ExxonMobil and get up into that 4 to 5, even 5 to 6 when you're talking about an AT&T, right? But anything north of 6 that's not a Blackstone group, I tend to kind of be a little bit cautious of, and I definitely stay away from those companies that are trading for less than $10 a share. They're given a north of 10% dividend, typically a sign of trouble with the company. So anyway, yeah, that's kind of the project that I'm working on the side. So interesting idea enough to look to utilize M1 Finance and the platform that it offers for investors to really take advantage of their free trading platform. Pretty awesome stuff. And that's one way that you could kind of carry over and mirror those Vanguard ETFs and build a portfolio for yourself free of charge. If I was looking for new exposure to the stock market, I tell you what, guys, I'm so excited to provide, you know, or at least introduce some of these really, really cool options that are available to new investors out there. A lot of fun, man, to be a new investor right now. Never been a more exciting time to be an investor. And I think that sentiment would have held true really at any time throughout history. I'd like to take a little bit more of a contrarian view on the stock market now, with the potential for the geopolitical risk to take a little bit more heavier hold on the stock market now. Whereas in hindsight, 2009, 2010 really would have been the optimal time to jump in the stock market. S&P has turned back over 300% over that time period. So really impressive returns. So just want to welcome some of the guys again. I've got Dave here from Average Joe Investing. Enjoyed his video. I will comment on it. If you haven't watched it, kick over there and support the video. It was interesting about him and his dad going in and talking to the financial planner. And I was watching the video and I was watching my son play soccer at the same time. And I kept looking down at the video and I was like, why didn't y'all walk out? I know he knows my opinion is certainly a little more jaded, but I think I said out loud, you guys are trying to over justify a poor situation, and I think he would agree with that. And I think he was trying to drive home the point that, gosh, his dad had worked so hard his whole life, had a little bit of savings built up, and then to go in and potentially be subject to that. I mean, could you imagine your dad going in there and being subject to that financial planner's information by himself? And you can't tell me for a second that he didn't notice after you started asking the questions that you knew a thing or two about investing, right? So would have changed the dialogue a little bit had you not been there, okay? And unfortunately, that type of stuff happens all the time. And, and that's the way I kind of looked at it, is that people look to just over justify for the lack of better options out there. And they're looking to say, gosh, this guy sounds really, really legit. He makes a good point. I don't know, maybe it is legit, when in all actuality, you called him out on the numbers, which at the end of the day, what is it that we always say? This is about money. And if you're going to make decisions and you're going to sign contracts to lock your money up for a 3-year term, absurd. That really got my attention. And I've never even heard of something like that. All the brokers that I've been with has been, come and go as you please. They service your account for as many visits as you need, but they don't lock you into any type of term or session or any of that. So really, kind of a good video, Dave. I thought it was good. So if you guys want to kick over and check it out, I thought it was cool. Cool video. Just an insight. I think it would have went probably the same had I been talking to him. I've had that idea as well, to go in and actually talk to a financial planner and act like I don't know what I'm talking about, but I just don't know how long I don't know how long I could keep that secret, man, to be honest with you. So, but it was good stuff, man. Average Dave Investing doesn't have the same ring to it. Average, no, it doesn't. That's funny. I got Christopher Blaine here. I'm taking a beating with my AbbVie. AbbVie's never really been a holding that I've taken to. I don't know why. It's a great company. The last healthcare name that I took a big stake in was the dip in Pfizer. I've really just, gosh, I don't mean to brag. I'm pretty transparent with my poor picks, so I will pat myself on the back with the good ones. Intel has been a good one for sure. I took profits at Intel at probably right at the top at 57. Let the thing come in. I have since stepped back into a position in Intel, and Pfizer was the same thing. Got out of Pfizer in the mid to upper 40s. I think it went above 45 and just took a nice chunk of profit in Pfizer. It's come back, and now it jumped back in below 40, and now it's looking like it's settling out here. But some of the other healthcare names, there was another one that I took position in as well. I think I re-upped my position in Medtronic. You guys will be interested in that. Of course, long J&J. But there was another one that I thought I had grabbed another position in, but maybe not. I'm trying to think the portfolio through in my head, but it might not have been. But anyway, I've got Ernest right below, who always just says hello. Very polite fella, just a polite fella, sitting back, chilling out on a Sunday evening, watching a live stream, Independent Investor Channel. Just a long-standing supporter of the channel. I definitely want to say hello. to Ernest, man. Good stuff. So got financial investor. Hey, out in the park now saying hello. Very cool. I love it. Investing wisely. Also, long-standing supporter, operates his own channel as well. Definitely want to give a shout out to Investing Wisely as well. If you guys have any questions specifically for Investing Wisely, he's in the community as well. Good stuff. Larry Massa says hello. I've got Korea on here as well, who's tuning in. Very cool stuff. Dad B, do you have an opinion about the tariffs? Since you asked, and there's not a whole lot in the community this evening, and I'm only going to go for about an hour tonight. I will give my opinion. Okay. I think the China tariffs are well overdue. The unfortunate part about this is the Chinese approach the world a little different than Americans. Okay. And I think the thought was that they were going to respond as if we anticipated them to respond. And I don't think the Chinese are as predictable as we think they are. I don't. I think the thing is going to draw out. I think we probably run more of a risk of taking the stock market down with us before there's real economic impact, which the economic impact is going to come shortly thereafter. I'm not really sure I understand putting a tariff on an import. In my learning, and maybe I was paying attention, I don't know, but typically hurts the domestic market, that of which the import is coming into. Okay, you guys can correct me if I'm wrong, but I don't think I am. So I think we run really more of a risk. I mean, we've got a community of folks here in the United States of just over around 400 million people, right, in the U.S. China's got like 1.3 billion people. Do you really think China is going to bow down to the demands of the United States? I'm not really sure. There's probably a lot of complex entities that go into the negotiations right now. I'm in the camp that I believe we've been taken advantage of for a long time. And I think China's been built up over that time based on them taking a strategic advantage over the United States. Why? Because it's been allowed to be done. So do I fault China for it? No, all is fair in love and war. That's just how it is. In business, it's not personal, it's business. And China has just exploited weakness on the side of the US for quite many decades. And that goes across multiple administrations. Okay, not to make it a political thing, but I would like to see it resolved. Do I think we're doing the right thing? I don't know. I think our backs are in a corner a little bit. I would like to see a little more reciprocation on the trade thing. I think we talk way too much about tariffs and a lot less about intellectual property theft, which is just as important, if not more important in my mind, than getting apples for apples as far as trade equalization. That's just my opinion. Do I think individual investors could run the risk of suffering a little bit? Yep. That's why I say all the time, the investing landscape isn't for everybody. Okay, you need to be able to accept the goods with the bads. All right. And if things do end up turning south a little bit because of a misconception, it doesn't actually have to be about the reality. Okay. It can be a lot about the perceived reality in the stock market, and it does end up suffering. We're probably going to give away our one leverage chip, which is a very strong U.S. economy right now in the short term. And my rhetorical question back for the group is, what do we do then? What do we do then? So what does it mean for us as investors? Quite frankly, I don't spend my day worrying about China-U.S. relations. I don't. I am an investor, and a savvy one at that. What I do is try to prepare everything that I can possibly prepare. Invest in those industries that are somewhat immune to the trade piece. each and every one of those growth names that I just gave you at the top of the show are in fact immune to that. There's going to be people who travel. Okay, there's going to be cloud computing needs. There's going to be search engine, needs through Google. Google's a juggernaut. It's continue to make money. Just a fantastic company. But as far as having that be your sole driver and influencing your investing decisions, I would say there's probably a better strategic plan for each and every one of the community members that come into the group, whether or not you're a beginning investor or middle of your life investor or toward the end of your life investor, than just focusing on the tariffs and waiting for things to shake out and we get a 10% to the upside stock market boom. Is it something that we're keeping track of? Certainly. Is it something we're ignoring? No, it's not. However, make sure that you're strong in your posture. All right. All the fundamentals that we talk about through the course of wealth building should be able to stand up to anything geopolitical, anything political, anything that is economic that's thrown at the stock market that may potentially throw a little bit of volatility in your portfolio. That's why we build them the way that we do. Okay, that's my thoughts. Wish I could say more, but I could say more and get a little more political than I need to on the Independent Investor channel. But really good question. Thank you. HD and 3M. Just a sec. I'm going to cruise up here. I've got HD and 3M are looking better as their stock prices drop. 3M, yes. I'm not really sure where you get that for Home Depot. Perhaps I've been missing something. I may be misconstruing Costco with Home Depot because I've been watching both of them. Costco's on fire. On evaluation, I looked at Costco, couldn't justify it. I love the company. I really do. I love Home Depot. I think Lowe's is just a better buy. I really do. It's hard for me to say that because I like Home Depot better than Lowe's. I just think they're a better business. I think they're better managed. But as far as a stock goes, I think Home Depot may see less upside potential than Lowe's, to be honest with you. That's what I see in the two home improvement spaces. But again, I would just be very, very careful with your stock picking. I would give you the green light on 3M. I actually looked at 3M and potentially doubling up on 3M right here. I did not. I exercised my right to hold. I in turn took a position. I believe I took a 5-share position in Lockheed Martin. Instead, diversify the industrials holding, obviously Lockheed Martin being the defense, a subsector of the defense. So we'll go ahead and buy 5 shares of Lockheed Martin right here, right, wrong, or indifferent. That's what we did. But I love both of those companies. Okay. Both Dow Jones Industrial Aristocrats. Okay. Very, very good companies. I've owned Home Depot, very spotty. I've probably owned Lowe's more than Home Depot, and I've made really, really good money with both stocks. 3M, I have done nothing but hold the stock in the red. I mean, literally, that stinking stock was up for maybe 10 days, and it was up quite handily, and then they reported again, and boom, I was back in the red again. But therein lies the pits and the perils of being an investor, and that's just something that you got to kind of get used to a little bit. Buckle up for a bumpy ride ahead, all good says. Potentially. I think there's probably more right than wrong in that statement. I would say the U.S. economy is very good right now. Okay, so don't think for a second that you can say one way or the other. I just think it's a little bit at its peak. That's just what I think. So be very, very selective about entering into the position. If you need to start in the stock market, use scale. All right. There's nothing wrong with, remember the $1,500 of exuberant expenses that I threw out there for the nominal household. $1,500 is just amazing, man. $18,000 per year just wasted away out of a $55,000 salary. And for you guys that may be making $30,000 a year, you probably are looking at these guys like, what are you doing? Like, Jesus, get some freaking control. But, 30% of your budget's gone, to frivolous things. So when I pose the question of whether or not you can parlay $25 a month from your budget, You can, okay? I don't even need to ask the question rhetorically. You can. The money's there. Statistically, we are a wasteful society, okay? The money's there. It's just whether or not you want to take the initiative to parlay that money out. And sooner or later, you'll identify that you've got a lot more than $25 to pay yourself and start to accumulate some wealth for yourself and stop giving it away and being that consumer that you're conditioned to be over time. All right. Be a little bit greedy with your money. Okay. Paying yourself $25 is hardly greedy. All right. That's just showing a little glimmer of discipline. Trust me. And if you can show that little glimmer of discipline, hopefully it becomes a little bit addictive and you start to become addicted to being a little more fiscally responsible. So AVA's comment, I like AVA, profit taking is a good idea given the rise. But the trade war swings also creates interesting long-term entry points. See, that's just a very, very smart comment, very smart. And there's a lot that can be learned by that comment, all right? You have to kind of look at it that way. Okay, yes, this is what's going on. It could either mean scenario A or it could mean scenario B. What is it that you do about it? You don't build a portfolio to account for just condition A or just condition B. You build a portfolio to satisfy all conditions, okay? The best that you can. Okay, there's no portfolio that's perfect out there, but there are certain rules of the road that we talk about all the time, all right? And for you new investors out there, start to get familiar with the sectors, start to get familiar with some of these things that I've written on the board here that'll help you with your evolving education. That way, when you do have the opportunity to strike at this market, you'll kind of have the lingo and know, yeah. I just can't believe I got that live. That'd be awesome. That'd be cool. You can tip for that. That was real. Very cool. Bless me. Thank you. All right. So anyway, laugh out loud. I also have Google on the buy list. I think Google is the premier. I hate to even call it a growth company because the way that it trades right now, the valuation is quite attractive on Google, but I did throw it into the growth names. So for you guys that are the loyal, I mean, I recognize every single name in the group here. So you guys will see that hit. You know, those are the videos that do quite well on YouTube. Whoop-de-doo, really, to be honest with you. I think they provide little to no value, to be honest with you. I'm being real. Okay, aside from just seeing the stock picks that I spent a lot of time researching, that's freaking interesting, great, but I know there's potential for at least one investor to grab that information and say, you know what, I'm going to start an M1 account with $100 and I'm going to buy Booking Holdings, you know, and that's the last thing that I want to see happen. But as much as I can speak until I'm blue in the face, people don't want to focus on that fundamental wealth building psychology that you have to succeed in the stock market. And I'll continue to preach it until I'm blue in the face. It is absolutely critical. But that's why I openly share it with you guys, you know, what I've got coming up, because that's real money. The cool thing about it is I don't come out with those videos, you know, stocks to buy for June 2019 every single month. I know how popular they are on YouTube, but I also know the potential that they have to do a little bit of damage for the ill-prepared investor out there, you know, who just takes the picks and just can't wait to hear Ryan's stock picks and goes and invests in them, especially that they know that I put real money on those stock picks. I mean, I give you the actual shares that I bought, and you know, that's just the way of it. Whatever. That's the one small entertaining piece, because you know, at the end of the day, I would like to see my message reach more people. So if we pick up, you know, a few good subscribers throughout those messages that come across those popular videos, then so be it. I'm all for that. But I just there's a counter argument to that. I think these live streams are the best product that I put on YouTube, bar none. Nobody does this. Nobody gets on YouTube and rants for an hour. You guys know that tune into me on Friday. I rant for 2 hours and it's all good stuff. I mean, I go as hard as I can every single live stream for you guys and try to address all the comments and questions that come in the group here. Dad D, I think it depends on the margin of safety on your purchase price. Just lump sum investing better than DCA in your opinion? Wow, that's a phenomenal question. I skipped over it the first time. I've got Dad D asking a very, very important, and I would encourage you to hear my opinion, okay? I don't give advice on the Independent Investor channel, but if I was you, I'm gonna throw a red flag, or I'm gonna give you a timeout for just a second, and I'm gonna give you advice as if I was sitting in your shoes. I personally am not throwing lump sums at this stock market. Hell no. And when I talk about scaling into the market, that's just a fancier name for dollar cost averaging. Okay. If you want to take a starting amount of $1,000 and do a starting position in the stock market, wonderful. If you already have 50, 60, 70, 100,000 already invested in the stock market, wonderful. I would look at the potential of maybe even skimming some profits off of that if you see fit. Okay. But the last thing that I want to see you do is take 25,000, 10,000, 25,000, 50,000, 100,000 and just dump it right on the S&P 500, or dump it right on a total market index, or even dump it on a 30 or 40 stock portfolio, a 10 stock portfolio. I don't care. You're really, really subjecting yourself to getting your jugular cut. All right. And I think a better approach is a smarter approach. Here's the smarter approach. If you're sitting on, let's say, and you're not giving me numbers, so I will play, and I will say, if you've got 10 grand at this stock market right here, what's the harm in buying 10 shares of the S&P 500 at $260, $2,600, right? Putting the white meat aside in a savings account, okay? Or even contributing max to the Roth IRA and keeping some to the side, and then setting up a dollar cost average to fund it, okay? So one of two things is gonna happen. Either the stock market continues to go up, you're a winner, okay? You've got 10 shares, S&P 500, VOO, sells for around 260 a share. You've got 10 shares of the entire S&P 500, that's wonderful. If it goes up, you're gonna enjoy some of that appreciation. You're gonna be paid dividends every single quarter that goes by, you're a winner. If the stock market goes down, you've got a little bit of pay dirt there to say, you know what, this market's down 10%. Ryan gave me the opinion on the Independent Investor channel to have a little white meat on the side, a little bit of pay dirt, right? I'm sitting on a 10 share position. Maybe I want to add a 5 share position into that. That's scaling, okay? Then you monitor the stock market. Let's say it bases, all right? It hits its support level at 10% down and it continues up, you're a winner. If it continues down 20%, you're still a freaking winner, because guess what we do now? We scale in another 5% at 5 shares or 2 shares or 3 shares or whatever. You're still doing the dollar cost averaging every 2 weeks, every month, whatever it is. Now, I will give you one additional layer. Since you've taken the time out of your evening to tune into the Independent Investor channel, I typically like to do strategic buying, okay? The volatility in the stock market has provided very, very interesting fluctuations throughout the day, to where if you get a down 400, 500, 600 point day, those are your opportunities to inject into the stock market. Why do I say that? It's because on your DCA schedule, you may have it set up on the 15th. It may buy at the unopportune time when the market's up 500. I mean, it would have been an unopportune buy point, you know, on Friday if you decided to wait and buy in the afternoon, right? Strategically buy, okay? Just monitor the market. It takes a monkey to watch the stock market and say, wow, it's down 400, 500, 600 points today. I'm going to go ahead and put 3 shares on my S&P 500 position. Smart, strategic buying. I'm the only one that talks about it. It's dollar cost averaging is kind of like an escape to thinking, okay? It's a lazy man's way of investing in the stock market, to where you're setting up injection points month in, month out, year over year, and over time, that best fit line that you draw is in between the market highs and the market lows. It's an average over time, okay? Therein lies the term dollar cost average, but I would very much encourage you to consider the prospect of not taking any type of big lump sum payment, and I'm talking about north of $10,000 into this stock market, unless you have other assets that you can rely on. If you're sitting on a 6-figure 401k or a 7-figure 401k, scratch what I just said, okay? You have the ability and the luxury of investing in the stock market the way you see fit. But if you are a beginning investor, do not expose yourself in that manner. Invest, yes, but do it with scale, do it smartly, and do it strategically, all right? It's a killer question. Thank you. It's the question of the night right there. I wish I got more of those because that's what brings out the best in me in helping you understand my position and what I would do if I was in your shoes, which I am. I'm an investor as well. And I've used the analogy many, many times that I'm kind of in second gear right now with this market. It's not really indicative of the growth stocks that I've got the buy orders in for, but that's fine. I'm in a little bit different position than a beginning investor. I have the money to do that. And I wanted to introduce some growth exposure to the portfolio, beef up on the consumer discretionary in the portfolio, and add a little bit more growth perspective over the course of my long-term portfolio holdings. Those are my favorite stocks that I have right now. For example, the PayPal holding that I added to my account, the counterbalance to the PayPal holding is my long holding in Visa, right? So I've got the Dow Jones, behemoth in Visa that I think makes more money than Australia combined as a company, I believe. Yeah, I'm not kidding. And then I've got PayPal, who's the fastest growing online payments business, who's just basically revolutionized the payment space as we see it. So real cool stuff. So I just came down. I'm scrolling down through my community, guys, and I don't know how long I'm going to stay on. It is a Sunday night. It is Mother's Day. But certainly I got Joe Carlson's in the group here. He says, hey, thanks for the kind words. You don't have to thank me, man. You're earning it. No doubt about it. I enjoy the heck out of the channel. Keep it up. Because I think the momentum that you have going with the channel is really, really good. Again, I'm not going to blow smoke at you either. I really think you're doing a special thing because I think a lot of people are watching your message and they're benefiting from it, okay? And that's a real rarity on YouTube, all right? The majority of YouTube is full of crap, okay? So keep pushing out that information. Stay yourself. Don't change, all right? I don't mean to be like a father figure. I don't, but I certainly, there's a lot of reasons why I do watch you. And I think a lot of those reasons that other people watch you as well is a lot of the reason why they watch me as well is that you got to be genuine. You really do. And I think you're just doing a superb job. I'd love to do a collab with you. So if you do hit me up behind the scenes, perhaps we can put something together. I'd love to talk to you and pick your brain a little bit about where you come from, where you get your investing savvy. I think it'd be really, really cool to talk to you because I tell you what, we're probably cut from different cloths. But I do contend that we're probably on similar paths as far as reaching our financial goals and having financial success down the line. So really good to have you in the group, man. You're welcome. I don't mind giving kind words to somebody who deserves it, no doubt. If I didn't think the world of you, I wouldn't say anything. I say that all the time. At Game of Thrones, yep, good. All right, everybody's going to turn off Independent Investor channel for the Game of Thrones. But anyway, added Square and Etsy this week. A little bit on the aggressive side of the house, a little bit more aggressive. I do like Square as a business, Etsy as well. Okay, little bit aggressive for my taste. So you're dabbling a little bit with the market at kind of a high right now. Both have taken a beating, but are great long-term growth. I do agree. It was a tough week to be reporting earnings. The market was very unforgiving. That's true. I'd like to know, how the Square and the Etsy fit into the total overall portfolio, and what type of position that you have. Depending on the size of the portfolio, I'd like to see you with a couple shares of each of those stocks. Nothing that demands or commands a high percentage of exposure to a portfolio. Those being high-level growth names, I'm going to tell you right now, the growth section of my portfolio is a relatively small section, okay? The majority of my holdings are taken up by good quality dividend-paying companies and passive sector-specific ETFs and total market ETFs, okay? And I've just added another 2% to my bond exposure, push up to about 26,000 in the bond, spread across about 6 Vanguard ETFs, both on the short, intermediate, and long-term bond exposure, guys. So I've pushed that up to about 13% of the total overall portfolio. So just be kind of careful, man. Okay, are you playing with fire? I don't know. Could you be up 100% a year from now in each one of those names? Yeah, you could. It's just make sure that it's in relative context to the overall portfolio that you have. Okay, so don't play with fire too much, but I think you'd be fine with those growth names. They're very, very good companies. I just want to make sure what you didn't disclose is some counterbalance within that portfolio, and the counterbalance is the good, boring dividend payers. And those are the ones that are the most boring. That's why I say investing done correctly is typically the most boring, okay? You're not going to get boredom with Square or Etsy. You're going to get a lot of excitement. You're going to get a lot of price movement. The same thing with the 5 that I disclosed on the growth side of the house, especially with Booking Holdings. That stock can give 100, 200 in a session. Very, very volatile, above action, above average price movement in each one of those stocks. So, it's a good lesson. So it's a good lesson in volatility. Just make sure that you have a counterbalance inside the portfolio. So good stuff. I've got player 1 in the group here, picked up some Wells Fargo cheap. Wells Fargo's been cheap for quite some time. And I think you could probably pick out, PNC on the financial, State Street as well, JP Morgan, Citigroup, Bank of America being my favorite in the financial sector. BlackRock has done a significant run up. Blackstone Group is actually dropping its limited partnership designation. So I've actually added it back into the Roth IRA. I know there was some restriction there. Anything over $1,000 of annual income on a limited partnership, you run the risk of sharing in some of the tax burden of the limited partnership. So that burden has since gone. So I've added Blackstone back into the Roth. I had it outside, made some profit with it, sold that. That's fine. I'll take the tax hit on that and then move the Blackstone Group back in, because that is a very, that's the highest dividend paying stock that I actually have. So wanted to have that dividend back into the Roth IRA. So Wells Fargo has been a really, really good pick. It's interesting because since the account scandal has hit Wells Fargo, it's really hit the stock price, but it's really ironic. That's not really Wells Fargo's bread and butter. It's not. And that's not the reason to own Wells Fargo. And I think there's plenty of reasons to own Wells here. 3% dividend clip, one of the best financial companies out there. I think they will, and they are taking the necessary steps to clean up their business. Really, really disappointing, the culture that they have built at Wells for all that time. I've never banked with Wells Fargo. I've had a few subscribers to the channel come and tell me some atrocious stories about their financial planners. So we'll continue to wage war on the financial planning industry. That's fine. I have no problem or reservation of doing just that. I mean, what are we? Just a little fella, with our little band of little YouTube channels. Maybe we can all, get together and continue to exploit the truth that goes on with the financial institutions. But yeah, Wells is a good pickup. I've owned the stock for a long time, and Wells isn't alone in the financials. I really think financials is very, very undervalued, but it's been there for a long time, guys. So I'm still long Citigroup, JP Morgan, all the ones that I've already mentioned. Wells, State Street is my newest position. Some interesting stuff. Great dividend holders. I'll continue to be patient on the financials as we get those to continue to shake out. The Uber Freight project is what I find most interesting in the business. To disrupt the trucking industry could be any thoughts on Uber? I bought 40 shares of Uber. So yeah, so 40. I picked it up at 41. I seemingly, I'm going to have to take this into some deep water. I do think if you're interested in picking up some Uber, It better not be your primary holding in your portfolio. Okay. I'm playing a little bit. All right. And it kind of goes against some of my passive portfolio rules that I have in the portfolio that are working. Coca-Cola is not going anywhere. Neither is any one of my other dividend aristocrats. They're staying, they're working, they're doing fine. My rationale for investing in Uber is very, very unique. I do see Uber to be in a position of power someday. They're very influential now. They have feelers in a number of different companies. I love the perspective and philosophy of the company. They need to figure out a way to not burn so much cash. So I do have some worry. So the 40 shares that I did buy, just a little bit under a $1,600 position, a little over a $1,600 position. But I had some discretionary cash within the Roth, and I figured I'd take a stab at it. Probably broke my own rule in that I probably should have picked up half of that position now and then waited for it to go sub 40. But y'all can play. You guys can play with my real money and just pretend and monitor it because I'm giving it to you. My buy-in was 41.57. So you guys can laugh at me or throw tomatoes at me if you'd like. It will be long. I will absolutely make it a winning position, and I believe that it will be. Okay. But I'm very excited to own the company. It's the first IPO that I have bought in a long, long time. And I told myself all the way up until the IPO that I would not buy it. And at the very, very end of the day, right at the close of business, I went ahead and put in the order for it. So I could be a hero. I could be a zero. I think I'm going to be a zero before I'm a hero. And I think it's going to be a while before I'm a hero. But I absolutely believe that at some point I will. And that may come 2 to 5 years down the line. That is the window of horizon. For the next 2 years, it is hands off on that holding. Hands off. Okay. And then we'll reevaluate the holding. That is the beauty of being an investor, guys. But again, it's relative to the total overall holdings that I have in my portfolio. It's probably around 0.5% of my total overall portfolio. Okay. So just to give you some relative perspective. All right. But I did buy 40 shares of Uber. All right. All right. I used the weekend to catch up with you guys, Ryan, you, etc. Your voice caught my wife's ear. I think I saw that wasn't I didn't say that. Somebody said it in a comment, and I thought that's really true, man. He does have a radio voice, but you know, it's just I don't know. I thought it was very, very calming. It was as if there was a zen coming through YouTube. So yeah, it was pretty cool. A lot of fun, man, but some really, really concrete information. So I just thought the last channel creator that I want to give a shout out here, Lydia Santiago from the great city of Los Angeles, the city of angels, tuning into us in the West Coast. So happy Mother's Day, certainly, and specifically to you. Thank you so much. I haven't seen you on here for the last couple of weeks anyway. I did miss Friday. So if you were planning on coming into the group and Community Friday, I do apologize. I had my dinner that I needed to go to. But anyway, K9 know I'm there half of the way. I will be there at the end of the year. Great. Any changes to holdings? K9 know you guys are just having a heck of a conversation here. But anyway, I will interject. I don't want to interrupt and say welcome. So nice to have your blessing. Player one, nice to have your blessing. Yes. So 30,000 is what Daniel Martinez is working with. So I get if I had to redo. So now that I know that what you're working with, I use 10,000. Now with 30,000, that changes my perspective a bit. All right. The fundamentals are still the same. Very simple. All right. We have a $6,000 cap this year, 2019, self-directed Roth IRA, etc. If you have no money invested in the stock market, then you can go ahead and max fund your self-directed Roth IRA now, 6,000 for 2019. That'll take you all the way up until April 17th of 2020. January 1 of 2020, you'll be eligible to contribute hopefully another $6,000 there. So by January 1 of next year, you've got the potential of taking 12,000 of that 30,000 putting it away in the self-directed Roth IRA account. I would certainly look at building up a nice buffer in the S&P 500 or the total market, stock market through Vanguard, and maybe enough there to maybe pick off a couple single stocks. You're not going to be able to buy the entire stock market all at the same time, okay? Now, the way that Joe invests, from what I gather from his portfolio, is he grabs a lot of exposure in a lot of different companies, okay? He's trying to manufacture that diversification within the M1 finance account. I think that's a great way of doing it, all right? But you're not going to be able to do both, okay? Don't think that you're going to be able to put sizable positions in every company out there that you want. I would say with that type of start, you could probably do minimum 2, maximum 4 positions, okay? If you wanted to do a couple more, you certainly could, but it depends on the amount of the base that you put in that. Remember the 10-share base in the S&P 500? You could do that. That's 2,600. Then do 2, 3, maybe 4 positions. Get some other pick your favorite sectors: healthcare, technology, maybe a discretionary name, and probably an industrial. Those would be the 4 that I would pick. Just a second, let me cross-check that. You could either do discretionary, financials, healthcare, industrials, or technology. Those would be the ones I would pick. And secondary to those would be real estate, okay? Probably put that into primary if you wanted to. And then energy, staples, communications, materials, and utilities you could do after that, if that's what you wanted to do, okay? You could probably approach it a little more defensive and look at it as an alternative and look at the utility sector in some of your single stock, right? Duke, Nextera, your Southern Energy. You could do something like that there, and then maybe a real estate ETF, because that's the one that doesn't give you that exposure to real estate there. But you've got some really good options there. But the answer to you, quite simply, is 6,000. It's easy. That's your maximum cap. You've got the ability to max cap that. You've got 24,000 of white meat. You put it away. You sleep easy. You're good to go. You come on and you're an active participant in the Independent Investor channel. And I am the one that tells you congratulations, because you've gone from 0 to something. You're an investor, right? You need to have some of that money working for you, okay? The other layer that I would consider looking at is a nice bond portfolio, all right? You could do something like that. And depending on how old you are, now see where the age comes in. Now you've given me the amount and maybe a potential risk tolerance, but give me your age. And that might dictate whether or not we want to even introduce some bond exposure. If you're in your early 20s, it may not be as necessary to introduce some bond exposure than if you're in your 30s, or like me in my 40s, or especially in your 50s, and then in your 60s. Certainly it would become a little bit more required of you to have some fixed equities and less exposure to especially this stock market in this condition with what's going on. Okay, good stuff. Yeah, my dividends pie started. It just jumped on me. Almost done here, guys. I went over a little, an hour. I had a great discussion tonight. I do want to make sure that I got a lot of these questions. Toward the bottom, it looks like there's some pretty good ones. Did you start your M1 account? Great. Any changes to your holdings? I hope K9 started an M1 account. I'm really liking it. And I'm actually starting to get into the back end of the research of M1 finance. It's actually quite good. I like it. I really don't have a whole lot of, I'm using it as a passive portfolio, and that's how Joe uses it, and that's how Lydia uses it as well. So, and Dave, I think, has M1, and I know Brent does as well. So, I just think it works better that way. That's just my opinion. All right. Yeah, my dividends pie started. Can't wait till United Tech splits to see how M1 handles that. That's interesting. I didn't know that UTX was splitting. It's really run up nice. It's been one of my top performers. I think I'm up, Jesus, 28%. I don't know. I've been recommending UTX for a long time. Just a phenomenal company. I was looking at Honeywell as well as the alternative in the other Roth, but I think I actually did not invest in Honeywell this time around. So 80% cash, looking for entry, believe end of May, start of June. It could be. I think it could be 20% of $1 million is a lot of money. So if you've got 200,000 invested and you're holding 800,000 aside, I would say, okay, that's awesome. But depending on your age and your risk tolerance, guys, right? I don't want to scare you out of the market, but I think you're close to the vest. You're being defensive, and I think there's a lot of value in that. I really do. I think the market is telling you a lot right now about where you should potentially be, full well knowing that there is no perfect answer to that. Okay, take what the market gives. Don't guess. Okay, build your plan to be smart in any market. Okay, and then the rest of it is just dusting off the fine edges most of the time. That's all it is. Okay, investing done correctly is quite easy. Okay, most of the time you're not going to do anything. As a matter of fact, the vast majority of the time you're not going to do anything. And that's exactly what I do on the majority of my holdings. Okay, they sit there and I'm an investor. That's it. They're gaining me share. It's a money engine. It might pay me a little dab of dividends here, a little dab of dividends here, but over time, man, those really, really add up. And they add up really big in a tax protected account. They really do. All right. No better path to wealth than the tax protected and wealth preserved path. Okay, we don't want to be giving our good hard-earned dividends away. And in M1 Finance, for example, and any of the other self-directed options that we discuss and is the center point of our discussion, I want to make sure that a dividend paid in a self-directed account is understood to be so much different than a dividend that's paid in a managed account. So much different. All right. And over time, the impact is hundreds of thousands of dollars of lost profit. Lost. It's gone. You cannot get it back. All right. So let me cruise down here. They're very smart. I love that company. Interesting that Joe Carlson mentioned even Waste Management had, but if a shady scandal way back, love that company. I do. I've looked at Waste Management a few times, actually. Didn't decide to pull the trigger this time around. It is on my list. I will continue to monitor it. I'm actually looking for a pullback in Waste Management, but we'll see what happens. Not going to be the end of the world if I don't get it. But yeah, it's one of the premier. It is the best in its particular field. So really like the company. Everyone should have speculated. Mine was Roku. Yeah, until you sold it. Don't mean to put a thorn in your side. No, Lydia might have bought it back. I don't know. I'm poking fun at her a little bit, but that stuff happens. I know she made killer money with Roku, no doubt. She probably invested in it again, but it had a pretty good jump last week. I saw one day movement up maybe 13, 14%. That was pretty good. I do like the company. It's really good. David Mathis says, nice seeing you guys. Ryan, how do you know when you have a rare taxable event in your Roth? It'll be on your disclosure. A rare taxable event I define as owning a foreign currency, foreign-based company like Total Energy, for example. I own a few in mine. Royal Dutch Shell should show up and they withhold those based on the tax laws of the company that the main office is domiciled. That's a rare tax event. If you're talking about something else, you'll have to hit me up offline. But I've had a few questions about that for the taxable side of the house. I fear not those types of things. Good grief. I've owned Royal Dutch Shell now for going on a year and a half anyway. Fat dividend payer and a great company, great management, sitting on a pile of cash, and probably one of the premier LNG providers in the world, along with Marathon Petroleum, which is really also one of my favorite energy companies. Like Chubb or Unilever. Yep, I like them both. They're really good. Would pay Waste Management. So guys, with that, listen, about a minute 20 on the live stream. I am going to log off here. It's a little over 10 Eastern Standard Time or Eastern Time, whatever the heck it is. But I thought I'd pop in and do a little payback for Friday. Do appreciate the latitude on the channel. Obviously, I do have some bullets in the hopper here to fire away. Some new uploads. How many accounts do you actually need? as an investor, and my top growth picks. I've already given them to you tonight. So look for that. Obviously love to have your support on the uploads, the 10-minute videos, that I put on there for the rest of the masses, that have an attention span of a pea. So, but for you guys that come on and strike up a little deeper dialogue with me, keeping the fire stoked on financial awareness, it's my favorite thing to do. It's my favorite topic. I do, again, want to thank the channel creators, Joe and Lydia and Dave and Brent and Investing Wisely. The folks that have popped in here help support the mission as well, to facilitate the discussion on financial literacy and awareness. And I can't think of a better conduit than YouTube to do just that. So guys, with that, have a great, great week. To the mothers that make their way to this, happy Mother's Day to you guys, belated if you do catch it after the live stream post to YouTube. Lydia, especially to you, happy Mother's Day to you. Awesome to have you back in here. And I will see you guys regularly scheduled time next Friday at 9 o'clock Eastern time, guys. Thank you so much for tuning in. Have a great week. We will catch you next week. Thank you so much.